I'd like to kind of go into the second section, which really relates to that. And that's the insights on company preparedness and anticipated next steps. I know from my own board experience, companies are really in various stages of readiness for the increased climate disclosures. Obviously, for smaller companies, let's say they're still large accelerated filers, but smaller companies, it's quite an undertaking, obviously, in terms of everything that's required to be able to get the processes, the controls, the technology in place in order to be prepared to have a single version of the truth, to report that effectively, and to do it in a consistent manner, all of which are extremely important in terms of, you're sitting on a board, you're a member of management, you want to make sure that those things occur. There's also, you've got TCFD that we mentioned in terms of the Task Force on Climate Financial Disclosure, but people have also elected other voluntary reporting frameworks, GRI or others. Perhaps they do have European operations, so their ISSB and others are very important. But nonetheless, a lot of companies, as Nicole mentioned, have California operations. And so you've got scope 3. And I think one of the things that's really important here too to think about, a number of companies have actually gotten ahead of what is actually required by the SEC. And I think the reason they've, a lot of distractive industry companies, obviously this is very important in terms of scenario analysis and what they're needing to report for investors and, various shareholder proposals that require even more information. So I think that's something that's going to be interesting to see how companies who have already disclosed, who have already set targets, whether they react or not to these new rules, whether they pull back, whether they plow ahead. And I think that's something to be seen. So right now, I'd like to get into and ask my fellow panelists a couple of things relative to readiness. And I'm going to start, Jan, I'm going to start with you. Just kind of as you've thought about over the last 2 years, perhaps even before that, some of the things that you've done in terms of preparation, the blocking and tackling that you've done, state of readiness, how your board perhaps was involved in that discussion along the way.
Sure, Barbara. Happy to start. So we have been aggregating and reporting voluntarily on our emissions since 2019. That actually is a baseline that we have for the company in total. And we look at that baseline based on the operational control of Jacobs, not based on our current financial statement disclosures at this point in time. So we have a significant share in a company that we do not report on those greenhouse gas emissions at this point in time. So the actual change in the rule is actually somewhat of a relief and help to us, at least in the initial period, for us to consider. The data aggregation process is very, very interesting around the globe. Certain parts of scope 1, 2, and 3 emissions are in slightly different states of readiness and cause us a little bit more effort to actually aggregate and synthesize. Some parts to this day we actually have to use under the greenhouse gas protocols. We actually have to do some estimation methods rather than actual pieces, which is totally allowable. And we're looking at those kinds of things going forward in terms of published targets that we have. We're one of the first companies who had our targets approved by SBTI. So those are fully out there. We've committed to reduce those emissions over a period of time, 90% by 2040. That is actually a disclosure we've made public a number of years ago. And last year, we actually underpinned our financial instruments with a sustainability-linked bond that actually has as one of its targets selected GHG emissions reduction. So regardless of whether scope 1 or scope 2 emissions per se are material, which you would not consider ours quantitatively to be material at all, It is clear that with a strategy in Jacobs being founded on an accelerator known as climate response and the voluntary disclosures that we've committed to already, we will be fully reporting as material going forward. The board itself, and I know we're going to get into a conversation around oversight, board committees, and that kind of thing. Our board has been incredibly involved since the beginning of us voluntarily aggregating and disclosing this information, as well as our broader sustainability commitments as Jacobs. And that has been a hugely helpful conversation and dialogue, both with our executive team and then as we have interfaced with the directors over this multiple year period of time since that initial set of disclosures. We've actually had a separate board committee for ESG and risk convened since 2021. And so that evolution of our thinking and engagement has really benefited from working together very closely with our board. I'll leave it at that, and we can.
Yeah, no, that's great. Thank you, Jan.
Sure.
Nicole, same question for you, and maybe just as as you think about what you've done, but where the gaps perhaps might be as you see the rulemaking as it is today.
Sure. Yeah, Constellation's also had voluntary reporting out there for a number of years. However, there hasn't really been a level of rigor around the processes and the controls to accumulate all that information for reporting. So even prior to the SEC proposal coming out, we did launch a project internally with a cross-functional team to make sure that we were very focused on that, just knowing how much more attention all this information is getting from investors. So we really did focus first on, we know we're going to continue to voluntarily report a lot of this information. So for us, there's greenhouse gas emissions data, but also water is a big focus for us as a company, being, agricultural based products. We also, have various diversity, equity, and inclusion targets and goals that are out there. So it's definitely a part of what we want to communicate to folks, both investors and other stakeholders. So, we've spent a lot of time on that voluntary piece, have also pivoted to trying to make sure that we're prepared as the proposed rule came out. We're talking to our audit committee. So it's actually not our audit committee that has ESG responsibility. It's our nominating governance committee that had that added to their charter. But with the influx of regulations and mandatory reporting, it's definitely going to be a cooperative effort between the two committees, obviously. So lots has been done both at the management level as well as at the board and committee level to just make sure that we're doing what we need to prepare. From what we've determined to be large gaps for us, it really has been on the financial tracking side. We've been working towards making sure that we have the information to understand what investments we're making and what impacts they're having on our targets and goals. However, we were in the really early stages of doing that. So given that we'll now have a requirement, we'll have to have assurance over this footnote. We'll also have to have information, just around risks, like Maura mentioned, spending to mitigate those risks and adapt to those risks, transition plans, all of those things are activities that we're doing that we'll now have to make sure that we're very focused on tracking and measuring so that we can report them if they are material.
Great, thanks, Nicole. And Maura, I just ask you, you're looking across a number of companies. I'm sure KPMG is on their speed dial in terms of what they need to do in compliance. Where do you expect to see probably the more significant gaps as companies are ready for disclosures now under the final rule?
Yeah, I think the sleeper issue is kind of the last thing that Nicole mentioned, which is climate-related risks and fully identifying them and understanding and really quantifying them for the organization. It's been interesting because when I read 10Ks and sustainability reports, the communications can be so different. And so I was just going through one recently where the whole premise of the business is really built on the fact that severe weather events actually generate more revenue for the company because their products get sold in those situations and in those scenarios. But then in their sustainability report, they're talking more about the investments that they're making in products that will respond to the energy transition. So, battery storage and EVs and generators that use natural gas as opposed to diesel, and sort of what that shift is. But there's no real discussion then of how those physical and transition risks are impacting the company, right? They're looking at it all as opportunities and not necessarily as risks to the organization. And so the SEC rule actually took out, reference to a disclosure of opportunities. So that's not to say that you can't do it if it's a key part of your business strategy, but you really have to highlight what your risks are, conclude and come to a determination that they are material, or if they're material, and then how that then ultimately gets built into your business strategy. And I think it's a conversation that needs to be had, and that maybe sometimes is discussed around the edges, but doesn't necessarily get embedded into the enterprise risk management process and then ultimately raised to the right levels. And so it's really good, right, to hear Jan talk about how management and the board are really engaged in all of this. But I think that is going to be one of the biggest hills to climb, is kind of to get everybody understanding what those risks are, how material they are to the organization, and then really how you talk about them in the context of your business strategy.
Yeah, no, thanks for that. And I guess, there's a couple really interesting issues I've seen just in discussion on my boards. One is making sure you understand the people in the room's perspective on climate anyway, because there can be very broad perspective. Climate, how real it is, how meaningful it will be, short, mid, and long term. I think that the second thing is just a typical issue with ERM is being able to get out of that 12 to 18 month period and look longer term. And clearly, as you think about climate risk, obviously you've got some impending, physical risk and storms and fires, and they're all getting worse. And we have crisis preparedness, and we think that we'll be fine, enacting that. But you get out to a longer term period, how it's going to impact our operating footprint. Where do we have things that are on the various coasts or in the line of fire, no, pun intended for some things, but how do we really deal with an evaluation of our operating footprint on a longer term basis in terms of the physical risks that climate represents? On transition risk, and Maura, you mentioned it. I mean, with my board, it's all energy related. It's usually about the energy transition. How do we really think about our ability to either have products and services that serve energy transition, or do we feel we're going to be disintermediated as a result of that? Again, it's a longer term conversation, and there's a lot of factors that are at play. So it's being able to really get a clear picture. It kind of goes back to the first point I made, which is get a really clear picture. What is your climate strategy for your company? And then how do you evaluate the risk associated with your strategy, whether it be a big change from where you think you are today or small changes along the way? You have to think in a longer term. And I think that's always challenging in terms of doing that.